Okay, so the last section that I wanted to talk about is the market approach. And again, uh, we typically use the income approach as our primary approach, and we use the market approach more as a secondary approach to try and triangulate with the income approach to see if we can get the two of them to jive, and if they don't, to try and understand why the market approach is so different than what the income approach is saying it ought to be. We look at guideline public companies, and we look at precedent transactions. And the key metrics we look at, depending on what type of business it is, are EV to EBITDA, EV to EBIT, price to earnings, and EV to revenue. EV to revenue is more for like, professional services types businesses, law firms, etc., dental practices. They all tend to go for multiples of revenue. So.
That's right. Dental practices are great. Right. Pharmacies are on time for years ago. And particularly,
Strips.
Yes,
That's right.
Particularly if they had a pre-1942 charter. Apparently now, Shoppers Drug Mart's brought up all these charters. They don't need them. They're selling them off, which means with a pre-1914 charter, you could own a pharmacy. And you're not a pharmacist. Who might be fiddling around in the back there behind the counter?
In Quebec, my understanding is Shoppers or any other big player can't actually own the pharmacy. The pharmacist has to legally have title to the pharmacy in Quebec.
And they're pushing for that here, which Shoppers is pushing back. Of course, Loblaw is not happy with the first one. You're very insightful. You're close to the market. You're close to the world and what's going on out there. What's your forecast for the economy? 6 months, okay. Won't have to hear. We'll see each other here.
I recently attended a CFA forecast dinner. A lot of smart people, and they all had different takes in terms of what would happen with the debt markets and the equity markets. But my takeaway was the European markets are expected to outperform the US and Canadian equity markets because they are depressed compared to the US and Canadian. Yeah. Coming from today, or like, say, a month ago, right, before things started correcting a couple weeks ago. The 19 trillion?
Yes, 19 trillion. Well, that was yesterday.
Okay. They have it in New York. It's right there at. It's right up there.
It's right up there.
Yeah.
And, all the indicators, which are all moving, and the debt is just.
You can see it ticking, and it's not just the last digit. It's like 3 or 4 digits.
3 or 4 digits at the
same time. That's
boom,
right.
Boom, boom,
Yeah.
every second.
It's kind of crazy.
But what works for me in my business is telling people that the world is coming to an end. The market's going to hell. This is the time to sell. All of the stuff that Doug talked about, his theoretical sort of approaches, makes for a great presentation, but he does the same thing. I don't know. I just don't know. I'm kind of concerned.
Well,
Yes, I am.
if you knew, you'd be retired.
Exactly.
That's right. You can make an educated guess. The thinking from the debt guys was there will be a flow towards equity in the next little while. Yes. Yeah. There is still a lot of demand for debt, and it'll continue, but there is going to be a bit of a flow into equities as people's appetite for risk increases. They are expecting it to go up starting, I think it's the second quarter of next year. That's right. And I'm talking about the US. I don't know what's happening with Canada.
So
Well, they've shut it off in the U.S. It's done. Quantitative easing is done. Yeah. Well, they've stopped certain parts of it. The offset is they have the German bank, the Bund, they have started their own quantitative easing. So there's some stuff happening in Europe because they're not in good shape. The Japanese aren't. I know, but they're part and parcel of the EU, so it can't just be a German thing. Japan's not in good shape either, so. A long time, they've been in that phase for a long time. They're still trying to figure it out. So there's a lot of uncertainty.
So with the crash coming, is it time to sell your you got it laughing at his joke here a little bit. There are people who preach it. It's probably 15 or 20 emails a day that come in from different U.S. organizations and whatnot to preach, the calamities that are coming. It's hard not to sort of take note and say.
Then there's geopolitical issues. There's all kinds of other overlays.
Keep going.
Yeah, there's a lot of nervousness out there, no doubt. But once you look past all the noise, it always comes down to fundamentals at the end of the day.
Good presentation. Keep going.
All right, so in terms of the comparable public companies, the key word there is it has to be comparable. You're never going to get a pure comparator to your subject company, but you want to make sure it's kind of in the same space in terms of a business and operating model, size, geography, etc. It's very easy to go to a Bloomberg database or a S&P Capital IQ database and say, here's my filters, click, here are my 10 companies, here are the implied metrics, I'm done. The devil's in the details. Some of these companies may look comparable on the surface, but they're not. They may be more capital intensive or less capital intensive than your subject company, in which case, guess what? The CapEx line doesn't line up. And so the implied multiple that it is spitting out is not something that you would apply to your company. So there's all sorts of adjustments that would need to be considered. It's not as simple as just going click, click, and I'm done, both for the public comparables and the precedent transactions.
A lot of people are very down on that whole concept.
Yes. In comps.
There's no real close comparables in any company.
I will submit a different issue, which is when you go to the market approach, it's been suggested, and I was reading this, or someone mentioned this to me, Damodaran, who's a finance professor who's pretty well known out of the US, he suggests looking at the market approach is conflating price and value. Because when you go to the comps, you're looking at what it's trading at, which is price, and the precedent transactions analysis, which something was bought and sold for, which is price. While in our world, we're trying to come to a value. So when you go to the market approach, you're basically mixing the price concept with the value concept. So he's saying that's another potential problem to consider. That was an interesting argument that he made.
Used to appear on TV on CNBC. For some reason, he's no longer seen. Everybody wanted him on their programs.
He's well followed. He's and he keeps a lot of stuff available for free online. He's not a big believer in compartmentalizing information. Yeah. That's right. So. Really?
Yeah,
Just
like we cut it off at in the lecture halls, probably about 400 people, and they have and 6,000 people in class. Those who only allow up to 400, 400 lecture halls back to university. Yeah, and 6,000 people sign up for the course, they'll rush putting the course on.
have you heard of demotoring? If you want to pick up a finance book to read, I would suggest picking up one of those. He's written many books on different topics. The last name is Damodaran. It's Damodaran. D as in David. NYU. Yeah. First name is Ashwath. Yeah. So just coming back to this. So in terms of the precedent transactions analysis, that's even more problematic because, you know, it's hard to say what they paid for. To the extent those implied metrics include synergies that were paid for, and you're looking at an analysis which does not include synergies, it's like comparing apples and oranges. Two different transactions, let's say they were both for $10 million. One was cash, the other was a mixture of stock and cash. Another one is a mixture of stock, cash, and an earnout. They're not all the same. So again, you know, the value that you get out of those databases, just look at the transaction value without looking at the consideration. Even though it does tell you about the consideration, the number that it spits out is based on the total amount of consideration without looking at the form. So again, it's apples and oranges. So just take the precedent transactions analysis with a grain of salt. That's all I'm saying.
Anyway, I don't buy into the market analysis approach. Not conservative things, similar companies.
And you may find, for example, a conglomerate with a business unit, which is very similar to yours. The problem is it's part of that conglomerate, and you can't extract that out. That's right. So it's very difficult.